Welcome to Money on Tap, your personal finance headquarters. Money on Tap is where we bring out the professionals' experience and some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. We look at all sides of the issues and we bring a fully independent planning perspective to the table. That's what we do on this show. Welcome to Money on Tap. Good morning, guys.
Good morning, Seth. You got some energy this morning. I'd like to hear that.
Absolutely.
Yes.
Good morning, everybody.
Let's get into the meat of this show. Folks, that's John Ryder and Ben Brayshaw, and we're all planners and partners here at Brayshaw Financial Group, and it's a pleasure to bring you Money on Tap. We welcome you into the room with us where you get a chance to kind of get into what do planners look at. That three-dimensional perspective is what we like to talk about here on this show. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook, 3D Investing. Now, we are really looking forward to our show today. If I didn't say that already, it definitely needs to be said again. So we're going to be talking about investing with your money. And today we're going to spend some time talking about a couple of methods of investing, passive and tactical. There are major differences between the two, and there are pros and cons to both. So if you have money invested today, whether it's in a 401k, brokerage account, online, you should have a good handle of how your money is being invested. And after listening to the program today, you should have a better understanding of how your money is working for you. We have had shows about this topic in the past, but every once in a while, it's good to revisit the topic, especially with the stock market being so volatile as it is right now. But before we get into that topic of our show today, it is time for Money in the News.
All right, so we have kind of a crazy story. I came across this the other day. The title of it, this is from People Magazine, because I just read People Magazine all the time. No, this just came across my news feed. Iowa man, 93 years old, finds long-lost wedding ring 45 years later in, everyone ready for it? A car engine. So this guy was recently reunited with a wedding ring that he lost 45 years ago. This is a guy from, where is it? Petersburg? It says Petersburg. I don't know if it's Florida. He says in Iowa. He says he lost his wedding ring in the fall of 1973, and he had no idea. He had no idea where this diamond jewelry could have gone. He never dreamed of seeing it again. So here's what happened. Sadly, his wife passed away a few years ago, but he took his old car. He had a 1972 Oldsmobile. It's kind of funny because it wasn't that old at the time, just a couple years old, a year or two old. He took his 72 Oldsmobile and he sold it just a few years ago. And the guy that bought his car from him was working on it. I guess he drained the engine or kind of ripped the car apart. And as he did so, something fell out. And there was kind of like a big, bunch of nuts and bolts and stuff that kind of hit the ground. And all of a sudden he realized he saw something kind of glittering in there. This is after he had been there for 45 years. So he kind of cleaned it off and realized he had actually found a diamond ring. And so you can imagine just what he must have felt like 45 years later.
How great is it that he takes the diamond ring and takes it back to the original owner?
Right. Is that cool that he did that?
Hey, here's a diamond ring. Is it yours? And I like the part of this story too, where he gives it to his daughter, who she lost her mom. He lost his wife to breast cancer, and she had breast cancer, came down with breast cancer, and so her sister came alongside her and said that this is really a good sign that everything was going to be okay. I really liked that part of the story as well.
And he said he had no idea how it all happened, but it happened. So I think that was kind of a happy reuniting of diamond and original
I
owner.
also like how his wife like couldn't stand it and went right out and bought him another one.
Yeah, isn't that funny? Yeah, she said, yeah, that's exactly what happened.
Yeah,
Yeah,
that's awesome.
right after it got lost in the beginning, she's like, okay, I'm going to get another one. So that's what she did. So the next story we have is kind of similar in a way. Well, it was just different, I guess, but it regards another kind of collectible, a rare penny. You know what's funny today about a penny? It used to be years ago when I was a kid, you saw a penny and you scramble down to get it. Now it's funny because a penny just doesn't seem to have a whole lot of value. However, there's one penny here that had a lot of value. And this is a story.
Yeah,
actually,
like $200,000 worth of value.
$200,000 of value. Yeah. So this is a story out of Boston.
Making you think twice walking through the streets.
Yeah. Well, this guy from Massachusetts, this was years ago, 70 years ago, he found in his lunch money from some change he got a penny. And it was one of these pennies that he didn't do anything with. It was a 1943 penny. It's actually one of 20 that was accidentally minted when the federal government was trying to conserve copper back in World War II. And I guess he was 16 years old when he found the coin and the change he received. This is back in 47. And,
well, that penny definitely looks different. And that's one of the things like for somebody to have an eye to be able to tell that that's something different, besides the date, I suppose, would be a giveaway. But just even the look of that coin is different than what we typically pass around today.
Right. Well, in fact, the guy that actually purchased it at auction, this guy is one of these coin guys who I guess knows the value of coins and all that. But it's amazing. Can you imagine you fork out $204,000 and the auctioneer gives you a nice boxed penny for $204,000. But anyways, this guy,
well, maybe that's better than the picture that got shredded for how many?
That's right, bank seed. Yes,
bank seed for 1.5. Was that what we were talking about last week?
Yeah.
Is that plastic or something on the sides of it? What is the white stuff? I mean, it's got to be something other than
maybe some kind of a holder for it. Maybe.
Yeah, that was kind of what I was thinking.
Yeah, we're looking at a page here. It's a large penny, kind of blown up, almost to the size of like a coffee cup. And you can see that there's some holders, I guess, on the side of it there. They're kind of holding the coin in place. But yeah, who would ever know? You got one. I want to find one of those other 19 pennies. Because there's 20 of them that were minted, so I wonder how many of them they have in captivity. But anyways, all the proceeds from this are going to a public library. Wow. So interesting.
Yeah. So YouTube top earner is a 7-year-old who made $22 million playing with toys.
What are we all doing wrong? I don't know what we're all
I tell you,
doing
my
wrong.
Kids are such underachievers.
They are.
I'm so upset.
Cassidy has 3 jobs. It doesn't matter.
Right.
It doesn't matter. No, it just so this is by USA Today.
I mean, is it too much to ask your 7-year-old to make $1 million?
I know.
mean, if this kid can do 22, why can't I get $1 million out of it?
Yeah, it is just kind of wacky, some of the things. It's just amazing what technology allows and what technology affords. But yeah, we're seeing this kid. I'm looking at a picture of him right now. He's a good-looking kid. There's no doubt. I mean, Ryan. His name is Ryan. He has a company through his parents, obviously, that's called Toys Review. And basically what he does is he dances around in a video for 5 minutes, showing off different toys that manufacturers are making. The views are like out of this world, millions and millions of views. And it just so happens that last year, because of all of his hard work in jumping around on toys and showing off and being cute and saying little pithy sayings here and there, he's made $22 million. So good for you. Good for you. I hope you have a good investment advisor out there, Ryan.
He said, he goes, I'm entertaining and I'm funny.
So, does that say it all? You better be really entertaining and really funny for $22 million is all I can say.
I actually went and watched one of these episodes.
I did too. And I'm sorry I wasted 5 minutes. It was kind of cute, but
I was blown away. I kept on expecting there to be some kind of, like a grand finale or some, I don't know, something really special to happen here. But it was him playing with toys.
I was very disappointed. And you know what I'm disappointed about more now, Seth? I'm disappointed that you and I both contributed to his income for next year.
Well, I haven't run out to Walmart and bought one of his toys from his toy line that's in Walmart right now.
Yes, but we did click on it. Yeah. And Ben, as we go further down the list here, there's some other ones that are very, very popular too. There's this guy named Jake Paul, who is known for his role as Dirk on the Disney Channel. There's a series, I guess, called Bizaardvark, never heard of it. He is also well known for his YouTube channel, which has over 17 million subscribers. He only made 21.5 million, so kind of a pauper compared to the first one at 22 million. And then, have you guys ever seen that, Seth? I know you have this group. This is a bunch of a few guys, I guess, 3 or 4 of them, a 5-man group actually, and they're called Dude Perfect. Have you ever seen them, Ben?
I have seen it. Yeah,
these guys are, they do things a zillion times on YouTube, and finally they, a million shots trying to get a basketball into a hoop from off of a skyscraper, and it goes through. They tape every one of them, I'm sure.
Yeah,
and then
right.
I mean, it's interesting. I'm sure they have some talent, but the talent paid off for them very well this year. $20 million. So
well, they also have a TV show.
Yeah. Have you seen that? Yeah, it's interesting. It's just kind of more of a sports type of thing, right? So it's always revolving, getting a basketball into a hoop, or just kind of crazy,
blowing stuff up or whatever.
Whatever it may be. And then there's a number of different guys too. The one that kind of most shocked me, and I have to say is probably something that I'm not really exactly thrilled with, was number 5 on the list. A guy named Jeffree Star, and I didn't include a picture on here, guys, because I just didn't think you'd want to see this. But the 33-year-old makeup artist turned beauty mogul. He sells $100 million worth of Jeffree Star cosmetics, according to Forbes, and he made $18 million last year.
Just on YouTube. He made $18 million on YouTube and $100 million on his cosmetics.
Yeah.
Now, I would have been really impressed if that was a 7-year-old Jeffree Star line of cosmetics. But the 30-year-old
number 5.
That's right. I guess this isn't all children, yes. But yeah, there's just some interesting ones out there. There's number 9, never heard of this guy. And I don't know, I'm not big on YouTube, I guess, but there's a guy named PewDiePie, 15.5 million. He's a Swedish game commentator. And I guess advertisers really like him a lot because they sponsor up to $450,000 a video. So somehow it must be driving business in an unbelievable way. So...
Oh, man. Well, there's bad news around that guy, too. I mean, there's a lot of anti-Semitic and racist videos.
Yeah.
I mean, that's crazy that he would be number 9. That's scary.
Yeah. In fact, it's funny. Even after we prepared the show, I saw this guy, Logan Paul, who's number 10 on the list, and the last one that we're going to talk about being a crazy millionaire. This guy has all kinds of scandals going. And I guess I'm not sure even exactly what he does. He just kind of shows some pop culture stuff, but I guess he showed some like an apparent suicide victim hanging from a tree in Japan. Just crazy. He's like a prankster, I guess. He's 23 years old, but for some reason has learned how to harness the internet to make himself a lot of money. But I don't know. It's just kind of wacky.
Well, I'm going to take this in a little bit more positive direction and wrap this segment up for us, guys. Hey, if you have a basketball out there, listeners in our podcast or radio world, and you take that up to, I'd say probably a 50-plus story building and can make a shot off of that, get that on video, send it over to us at Money on Tap. We'd love to see that, and maybe you too can make, an unseemly amount of money.
We'll sponsor you. Seth has offered to pay you some money for that.
Yeah. Oh, my gosh. Hey, you know what? We are going to come right back at Money on Tap, but we're going to take a quick break. Can't wait to get into passive and tactical investing and understanding the difference here in Money on Tap. Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, and if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
Now back to Money on Tap with Ben Brayshaw, John Ryder, and Seth Krussman.
Welcome back. You're listening to Money on Tap, your personal finance headquarters. Money on Tap's where we bring out the professionals' experience and some fun in what we call three-dimensional investing. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You know what? We are excited to get back into this show with you. We're talking about passive and tactical investing and understanding the differences here. So when it comes to your money, you can invest in any number of ways. Some people choose to be conservative with their investments. Others choose to be moderate. Others choose to be quite aggressive.
Yeah, there's no doubt that there are some investments which are very conservative and others that can be quite aggressive. And today, to get started, just for a few minutes, we'd like to talk a little bit about why you might choose a more conservative investment over a more aggressive investment. We'll also give some examples. But once we cover this, the bulk of our conversation today is going to be talking about two major philosophies of investing. We call that passive investing and tactical investing. And, we've talked about this in the past, but today with the nature of the markets being so volatile right now, I think it's a good review. It really wouldn't hurt to be able to talk and review those with our listeners.
John, it's kind of like we're going to jump into risk. I think the thing about risk is that the kind of risk that you're going to take in an investment is actually going to define sometimes whether you're going to be passive or active in how you invest. Ultimately, there's a number of different pieces that, when you define risk, it's the time horizon, the investment objectives. When you start breaking down all the pieces that are going to define when you walk through the door what you're going to do, it's really hard, to help people make the decision without getting the information. We talked a little bit about, in the past, we've talked about, making sure you find the right advisor and finding that right relationship and so forth. That has a lot to do with them understanding your risk, what you're going to do with the investments. How are you going to accomplish your goals? Okay. And so when we talk about passive and active and tactical investing and all the different pieces of it, they're so confusing to so many people. And for us, it's kind of layman. So, I'm excited about the dive in today to try to define those, give value, because, hey, we're 2019 and folks, the volatility is not over. I keep hearing that over and over and over again on the TV, in the magazines. Watch out for that volatility. We've even sent out our market newsletter, and we've had some great success in some of these areas. So I'm excited to share some of that stuff today. But I think the dive into just understanding some simple risk kind of scenarios for people might help give them a little bit of background on how to look at passive and active, because it's not whether one's right or wrong. It's whether it's going to accomplish your goals.
Yeah, what's most suitable and what makes sense. So, for instance, what we basically boil it down to just a few different time frames. We can have a very short-term time frame where we're just looking at, maybe 2, 3, 4, 5 years. We may also have a scenario where it's more of a moderate time frame where we're looking at maybe between 5, 6, 7, 8, 9, 10 years, somewhere in there, or maybe long-term.
But if you have a 2 to 5 year time horizon, it's funny how people will walk through the door and say, yeah, I really want to be aggressive with these funds.
Yeah, so we really have to kind of help steer them in that way and really talk to them more about really what their goal is. If you have a client that comes in, they've inherited $25,000 and they want to invest it for their kids' education, for a few years out, the way that which we advise that client would invest that money would be a lot different for someone that has a time frame of 20 years out. It's a whole different deal.
Yeah, and I think people don't really understand. They want the returns of an aggressive investment when it does well.
We all do when it does well. Yeah.
Right. But someone who walks through the door and says, hey, I really, if it was November, I really want to take an aggressive approach. The market's doing well. I've got 2 to 5 year time horizon. There's a number of advisors who would be like, yeah, let's throw this in, XYZ, and let's see if technology will be good for you. Well, all of a sudden you lose 15, 20% of your money in December. It's not exactly what you were prepared for. And I think, looking at, what was it, John? You were telling me that this December was the worst December since the Depression or something?
It was, yeah. We've just seen it. It's been a terrible month for stocks in December of 2018. And we had, during that time frame, we had a 7-day stretch where 6 of those 7 days we had the markets, the Dow Jones Industrials, drop by 350 points or more. So
that's crazy. Yeah. That's crazy.
Yeah.
What was it? What was the other statistic in 2018? There's been 8,000 point drops in the stock market,
Oh
right?
yeah, and
Yeah,
five
of them in
those.
2018.
Yeah, five of those in 2018.
I mean,
Yeah, that was in the Dow. Yeah. So, risk is one element that we're going to talk about and bring in. And it's interesting for us. It's interesting because risk can be something that's very personal to most people, right? Like you have the person that comes in and they're like, hey, I really am a high risk investor, but I've got this time frame of 2 to 5 years. Well, that's a conversation that may not feel comfortable for the person that's more high risk in their who they are and what they're willing to take on. But then there's the other side of that as well, where we talk with people that are very, very low risk in their investing, but they have much greater time horizon. So it's an application process, right? For what are those monies going to be used for? How is that suitability going to kind of trickle down? Now, I do have a question for you, okay? If you are an aggressive investor, right, which might be somebody that has in the time horizon more than 10 years to invest, and you're looking into passive management strategies, are you a passive aggressive investor?
Now that should be reserved for our staff psychologist.
That's a fantastic line.
Staff psychologist, where are you? Yeah.
I think the interesting, I mean, besides that, Seth, and that will be a trademark for you, I'm sure. So, but there are so many areas of gray inside this, right? I mean, when you shift, like the conversation of shifting between passive and active, like when does someone flick the switch and go from one to the other? Mm-hmm. Like there's some of that. Like people say, well, when do you know when I'm going to be one person or another scenario inside that? That's the hard piece, is understanding the nuances inside this. Like, so I think what would be really good right this minute is like, let's just go through and just define the passive and active management and explain where tactical comes into play in this, and then start walking people through the conversation of the layman's understanding of why you might do something and when those risk tolerances inside here might play a role.
Okay. Ben, I think the great majority of people that we see when they come into our office for the first time, the great majority of the people that we see have an investing style, whether they know it or not, but they have typically a passive investing style, meaning that we might have a scenario where someone comes in and says, hey, listen, I have $100,000 in my Fidelity 401k. I have $50,000 sitting over in this mutual fund. And many times we'll see it invested passively. And when I say passively, I typically mean maybe they have an index fund that they have. It might be a Vanguard index fund that they have.
Or
S&P 500.
Sure.
Yeah. But even then, they might have like a large cap or small cap, mid cap, something like that might be.
Yeah. I usually see 2 or 3 or 4 investments. Like I don't see, like when I start seeing 8 or 10, I'm like, so why'd you choose these? And I mean, most of the time when they have 2 to 4, they have no idea. 8 to 10, zero idea.
Sometimes it's maybe, well, I'll put 20% here, 20% here, 20% here, 20% here.
Right. That's where they get the 5.
Which is diversification, right?
But I hear one gentleman said, well, honestly, I have no idea why I put that here. And that's what I expect to hear, which is totally fine. And every listener should know that we expect to hear that you don't know what you don't know. It's okay. But I think I had one guy say, well, I heard about this fund because this guy was doing well, so I started putting money in there. And then, a few years later, I heard about another fund that was doing well, so I started putting money in there. And it's like they're chasing returns.
Yes, or maybe the guy in the next cubicle over at work 2 years ago, he put his $30,000 in there, and now he's at 45. I'm going downhill in whatever I chose. Right. So maybe it's kind of that. But passive, really, what it's doing is following an index. So if we talk to someone that says, really, hey, I want what the Dow Jones 30 is getting, I want what the S&P 500 is getting, I want what the Russell 2000 is getting, they would just pop the money into that index, and no matter what happens with that, they kind of just go up and down with it. And they don't say, okay, I'm going to pull it out now and put it in now, and I'm going to move to cash. It's not that kind of thing. It's simply they put the money in and kind of let the index take care of what that return is going to be. It's a very passive way of investing.
Now, technically, you do not buy the index, but there are these funds that track and follow alongside of, and that's the goal of those passive investment funds, is to really try to follow those indexes. Or, there's all sorts of indexes out there. Indexes are created almost daily, it seems like anymore, and they really are trying to follow or mirror what a segment or a part of, maybe it's the economy, or maybe it's all these different factors. So, so that's definitely a passive strategy. But there's the buy And then there's the sell, right? And that's the active where it comes into, like, how are people engaging around that piece? And so the passive, you know what, you buy, hold, and that's a passive strategy.
Yeah, I mean, so for simple terms, for people listening, right? So passive, is simply the conversation where you hear set it and forget it.
Right.
Right? Buy and hold. That's passive. That's saying, I believe in this. This should work out over the long run. I'm just going to own it. And if it doesn't work out, well, I was the 1% or 5% or whatever percentage you believe it to be, the loser. But most of the time, the vast majority, I should be fine.
And Ben, it could be with passive, it could be a number of different things, like we were talking about a number of different indices. It could be stocks, which we always kind of think of it, we just all kind of like that stock return story of it goes from 10 to 100 and you become a zillionaire. Or it could be bonds. It could be commodities. It could be any number of different asset classes.
It could be
right?
mutual funds. It could be anything, but you buy and you hold. You set it and forget it. I mean, that's honestly what, it's funny. I was talking to somebody about a 401k when they walked in and were asking us some questions and stuff. And they said, well, I'm kind of the set it and forget it. Like, that's a terminology that's pretty commonly used in our world. And there's two reasons why. I honestly think it's a little bit to avoid issues in our industry. The 401k companies will come in and say, well, you buy it and you hold. You buy and hold. That's a good philosophy. Set it and forget it. It's, well, two things. They get less customer service phone calls, right? And less explaining to do. So it's, and people don't understand the stuff well enough anyways. It's very complicated. They need help, and companies don't have the resources to provide that help. So they're like, congratulations, set it and forget. Oh yeah, you should, when you buy these things, you should be in it for a long haul. Expect volatility, expect up and downs.
So there are some definite pros about the passive investing. I thought maybe we'd talk a little bit about the pros and the cons of each, but there are some definite pros when it comes to passive investing. One of them that I think right off the bat is what you were talking about there, Ben. You set it, you forget it. How hard is that to just let it go for 20 years, So it's very, very easy, and the ease there is you have to worry about it.
People don't want to worry about working on it.
Right. It's
Doesn't
done.
that work for you?
So
that's what the pros are saying.
That sounds like a pro to me. But there's another pro too about passive investing, and that pro is typically passive investing is a lot cheaper than active. Obviously, if you set something and forget it, like you buy a car and you never do a thing with the maintenance on it for the 10 years that you own it, well, you probably run into some problems later on with it. But the fact is, it's pretty cheap. No oil changes, no tire rotations. You don't have to worry about putting steering fluid
most of the time. And I would probably say, the only caution in that piece that I would say is, if you're in a 401k and you have a number of, mutual fund options that you're choosing, those fees and expenses can change on you over time. And if you're in a set it, forget it scenario, you could see those fees go up. But traditionally, if you're looking at some of the index, passive scenarios, they should be the less expensive of the options, which I think is where we're kind of focusing on. But I think people don't monitor this stuff, and these companies can change fees, send you a new prospectus. I mean, that's what all this stuff is. It all happens all the time. Yeah. You can find yourself buying a reasonably priced fund, and next thing you know, you're in a very expensive fund.
Ben, I think that plays into the con then. So if the pro is not really having to worry about it, the con is, well, if you're not paying attention, if you're asleep at the wheel, that could be a problem as conditions change in the markets, as we have maybe even fund changes, all those kind of things. A lot of different things can happen, or maybe even like you're talking about fee increases that you're not even aware of because you've set it and you've forgotten it, right?
Yeah, right.
And so that pro can also, at the same time, be a con.
Yeah, like people say, well, just don't look at it. Don't look at it,
Your relationship is fine. Don't look at it.
You're listening to Money on Tap. We're going to take a quick break, and we'll be right back with more passive management and active management and how that really can impact your portfolio. You can reach us at 855-226-8551.
On this Cliff Notes edition of Money on Tap, John Ryder introduces an interesting story about a lawsuit that wraps up with an incredible outcome.
Ex-Chipotle manager accused of stealing $626 given an $8 million settlement for wrongful termination. New York Daily News reports that this manager, her name was Jeanette Ortiz, she was accused of stealing $626 in cash out of a cash register from the safe of a Fresno, California Chipotle Mexican grill. She was very quickly fired for this blatant thievery and justice was served. Right? Well, not quite. While her superiors maintained that the act was caught on tape, they failed to provide this purported surveillance footage and claimed it was destroyed. Frankly, claiming your main piece of evidence was eradicated isn't exactly the best legal argument in a courtroom. They accused her of something. They couldn't prove it. And now she is going to be retired for the rest of her life with no worries in the world at all.
Honestly, this is what's like bizarre about our legal system or wrong about our legal system. It's like, did she really steal it? And then she got $8 million. It's like, this is what the problem is with our system. We're encouraging more people to create more lawsuits. It's like the cup of coffee. Everyone knows the cup of coffee that's spilled on the person at McDonald's and they won millions. It's supposed to try to make you whole. No one ever is whole from anything, you know? And so to overcompensate or only exacerbates the problem we have in our legal system.
Thanks for joining us for this Cliff Notes edition of Money on Tap, with great tips from the pros in three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. Now here's more Money on Tap with Seth, Ben, and John.
Welcome back. You're listening to Money on Tap, your personal finance headquarters, where we bring out the professionals' experience and some fun in what we call three-dimensional investing. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Now, we are talking about passive versus active management. And Ben was making some great points there. And I want to come back to you, Ben, on what you were saying there in regards to the passive investing.
Yeah. Well, so Seth, one of the things I think when people hear passive, they think do it themselves. That's what I think people hear all the time. So we do passive and we do active investing. And why would someone hire us, I think, is the question to do passive investing. One good example is just what John was talking about with, we talking about fees and expenses and so forth. I mean, you need someone who's, monitoring that stuff, who knows that you're in the right passive holding. Like Seth said, you're not buying the actual index, you're buying a mirror or an attempted mirror of that index. And so, you want to make sure you've got the right one because, different managers change hands. You want someone taking care. If you believe in passive, that's fine, but you do need someone who's going to look out for, because if you're going to ride something for 20 years or 30 years, it might be the concept of passive investing and riding that portfolio. Like if you want to own the S&P 500, there might be times when, you might just be in the wrong, index mirror of the S&P 500. There might be one that has a better manager, or a manager starts getting a better track record. You want to know those things. You want to have that information at hand.
It's really hard to believe that as you take a look across the passive funds, just call it S&P fund XYZ, there's a difference in those returns. Like some of those are better at doing passive management.
Yeah, people don't pay us because we're nice guys. I mean, they pay us because
we are nice guys.
Well, John, it's kind of presumptuous. No, they pay us for the work. I mean, so why would someone pay somebody to do passive investing? And so that's a really interesting thing. If you're listening to this today saying, I'm managing my money at XYZ and I have a person to call into and so forth. Well, they don't have to answer to you because sometimes you might call in, you might get a whole different person. You might get the same person, but they tell you, hey, just hold on.
Yeah, a department perhaps.
Yeah. And that's, well, I mean, that works for somebody, but are you really doing the best? Are you doing the best you can? So understanding that you do pay people to do passive investing is really kind of something like, why would I do that? Well, because you need to understand all the variables inside that, because you can't just build a ship, put the sails in line to sail across the Atlantic and expect that there's not going to be winds, currents, or changes that are going to affect anything you do in any direction.
And Ben, I think that's a very good segue for us as we start talking a little bit about the active side of investing, because active is really quite a bit different than passive. And I'm going to let Seth kind of roll with this one here.
Yeah, truly the kind of the opposite of that passive, where the portfolio strategy or the person managing that is trying to exploit market inefficiencies by either purchasing securities, stocks, bonds, et cetera, whatever those are, that might be undervalued and, expecting those to rise and then possibly short selling or selling some securities when those are overvalued. But it's that buy and that sell. So buy low, sell high is typically what the goal is there. And with that, the hope of most of those strategies is to outperform what the passive is doing through periods.
Yeah, and that belief that can actually happen. I mean, so, it's funny because you turn on the TV at any point in time when the market is playing in the favor of active or passive investing, you'll hear, I see it like CNBC will have all the people who are in that domain who are being, are achieving excellence for that period of time.
They were beat up 6 months ago, but now it's time to bring them back in as the experts, right?
Yeah, right. And so it's back and forth. And the truth is, it just depends on the time period you're in.
It reminds me kind of, you guys remember that guy, his name was Harry Dent. He forecasted he had a book that was entitled Dow 20,000. And this was years and years and years ago, I think when the Dow was around 4,000. And he just got lambasted. And then also the markets go up like crazy. And guess what? Everyone wants Harry Dent back because we're getting up there where the market's been crazy. And so I think you're right, Ben. It kind of goes back and forth with what's in vogue for today, what's happening in the markets, and who can we bring onto our show to talk about great market returns, or why, it's the bull versus the bears. We've talked about that a lot of times.
Yeah, and I think when you go back through active versus passive, and you're looking at these different companies and when they performed and how they performed, I think there's a lot of appetite to it because we have clients who want both, who want us to do certain pieces, and we do it gladly. But we evaluate some of those risk scenarios, like somebody who's coming through the door who has, they want to give $25,000 to their son who has a 2 to 5 year time horizon for college. And it's like, hey, listen, we're not gonna run this money, passively through the market, in any capacity. Matter of fact, a CD would probably be the most appropriate spot if it might be 2 years.
Sure, especially in our current environment.
Yeah, because if you put that money in November and lost 15-20%,
no one's happy.
People are not going to be happy and say, well, how do I make that money up in 2 years now? So those are really kind of complicated scenarios. I think what was really interesting with this show, in prepping for the show, was, the Googling, the Wikipedia of passive and active investing, and how generalized it is.
Yeah, it's all out there, though. Yeah.
It's all out there, and not all of it's entirely accurate. It's kind of interesting to me because, and I don't mean accurate like they're not giving you the right information. They're just not giving you enough information to understand all the different spectrums that these things crisscross on each other, right? For instance, you could have actively managed passive investments.
Sounds like passive aggressive that Seth was talking about earlier. Yeah.
So you could buy a passive investment with like an index and say, I'm going to trade in and out of indexes.
Sure, and that happens all the time.
That happens so that's a different type of active management with a passive vehicle.
Well, Ben, the good news is with Wikipedia, you can go in there and make your own edits. So if we see any edits on the Wikipedia section, Ben took care of that.
We'll correct it. Yeah, we'll take care of that.
Hey, so let's talk about active. Let's talk about kind of an active approach, perhaps maybe an approach that we've used in the past. Ben, how would you necessarily define active?
Well, we were joking around before the show. I was like, there's like left wing and right wing,
okay,
and there's everyone in between.
Ben, let's not get political here.
So, but I mean, and I don't know which way this would fly. I didn't really actually do that much comparison in the joke, but there's people who are like, subtly active. That they make changes once in a while, and it's very intentional, but it's thought out and it's intended to be active, and we know there's going to be trading going on.
That's our engineer type clients. Clients that are, they read the headlines, they see what's going on. It's like, well, you know what? Maybe it's time to shift focus a little bit.
Right.
Maybe it's time
I bought
to
Apple at 80, now it's 200, now it's back down to 150. They trade in around those numbers and stuff. And so there's those type of kind of subtle active traders. And then I think you get to the people who are literally day traders, so to the extreme, right, where they're trading every day and that's what they want.
Are there any of those guys left? I think there are.
There's a lot of them. We discourage that kind of investing highly.
Most of them are passive investors now.
Yeah, right. I guess I got a hold now. I lost all this money.
They got beat so bad they just had surrendered.
And so as you're breaking through the active world, and you're trying to understand that, then there's like degrees of complexity that you can add to the active, like where you start taking in what we call technical or fundamental analysis and stuff, where they have computer generated models and then they've got emotional driven models,
algorithms going.
and they have algorithms of emotional models.
Yes.
You know,
I'm depressed.
Yeah.
I'm not going to buy. Yeah.
and or they feel, and then there's like the traders who just feel like, hey, listen, I feel like there's going to be a problem here in the market, and I see some kind of stuff. I don't have any real, knowledge per se, but I feel like we need to get out, or I need to get into this.
I think too, guys, I've been seeing a lot lately where people are following the VIX. So the VIX is basically an index which tracks emotion, or the volatility that people feel, and it's basically how people feel. So if the volatility index is down low, then it's a whole different scenario than the volatility index is high.
Yeah, I guess I got to ask you. I mean, I've never was ever called me to find out if it's volatile. I mean, I'm not in that index.
Exactly.
So, but that's, I think when we start thinking about active and we start really, correlating active, anytime you decide that, changes are going to be made, there's some degree of active that's involved, right? I mean, even in the subtlest form. So are you like a small player in the active space, or are you an ultra active?
As a manager, as an active manager, we might look at an active manager that might do this. He might say, well, you know what? I see some market inefficiencies that are going on over here in this sector. Right. And as a result of that, I think that this may be a good direction to go in. Or he may see just a whole area of securities that are undervalued out there that people aren't paying attention to. And he may say, you know what? This may be a solution for my clients.
Right. And they, a lot of it's, they use quantitative measures. They break down, a lot of the pieces that show like the price to earnings, the PE ratios, all these numbers that they talk about. Like, I was listening the other day about Amazon versus Apple and the PE ratios. Sure. and how off they were comparatively. And so, people are buying on what the speculation of the earnings are going to be per share, and what they think that value is. And all of these pieces they're looking for value, looking for opportunity, trying to buy in and sell after they, receive some of that value back. Right?
Sometimes the active managers are using strategies such as options. They're using asset allocation. They're using short positions. They're using all kinds of things. Seth, you had a word you like, arbitrage.
Love arbitrage.
Yes. And so they may use that as well. So there's a lot of different scenarios that they use when doing active investing.
And I think, so then you get into a lot more complex levels of active investing, where you're not only active, but you're literally, because active investing means you're in the market. Okay. So mutual funds, one thing about mutual funds is that they're always in the market and they actively manage. So they're actively buying and selling things inside there, but they have to maintain their investment in the market. Okay. So for people who own mutual funds, are like, it's funny because we've talked about this on the show. Mutual fund companies will come in and they'll solicit us and they'll say, hey, listen, I want to show you how we did. And we always ask, hey, what did it look like in 2008?
How was 2001? Yeah.
Yeah. And in 2008, the S&P was down 37%. And they'll be like, we only lost 24%, or we only lost 18%.
So if I started the year at $100,000, I'm down to 76.
Yeah,
okay, how does that shake out? Yeah.
So they have this explanation that, hey, we did really, really well. We only lost.
We did better than the unmanaged index. Yeah.
Right.
Yeah.
And so I can appreciate that because, and other people say, well, I don't want to own a mutual fund or something like that goes down like that. But when you understand that they have to be fully invested up to a high ratio percentage.
Right.
Like
so by prospectus,
80-90%.
When you purchase a mutual fund, you get a prospectus from your investment advisor, from your registered representative. And if you take a look at that prospectus, which you should do, it does talk about how much can be perhaps diverted to cash. They may say, well, because you're in a large cap mutual fund here, you may only be able to go to 5% cash if we see things are going poorly.
Right.
And a lot of times the reason they're going to cash is because many times they have liquidations that they need to make for people that are scared about the market.
Yeah, and so they're buried having to be in the market, right? So if you have to deal with the fire or the pain of the market, the question is how'd you do relative to the index pain? And trying to beat those numbers is the correlation that they're trying to show. But then you get into a really, really interesting area that we play a lot in, which is the tactical market space, which is where active investing takes place. But inside that active investing, there is the ability to remove yourself in part or in whole, 100% to a cash or cash equivalent.
And boy, can that be a very, very compelling idea when you're looking at markets that we've experienced. And we're going to talk just a bit about a strategy that we've used with some of our managers as far as that opportunity to be able to go to cash if needed. And we have found in these last few months that this tactically managed strategy that you're talking about, Ben, has really helped our clients in a tremendous way. The ability to say, you know what, we don't have to stay in the market. We can actually move a portion or all to cash. That's been huge.
We're going to take a quick break here at Money on Tap. When we come back, we're going to talk a little bit about what we've done in the tactical space around our portfolios and working with our clients. Pretty excited about that. You can reach us at 855-226-8551.
Hi, my name is Ben Brayshaw, one of the co-hosts of Money on Tap. If you have questions when it comes to your retirement and are looking for a personalized solution, contact us at Brayshaw Financial Group. In today's volatile stock market, we can help you plan to find your successful retirement solution. Am I saving enough? Am I saving into the right places? Do my investments match my appetite for risk? Do I have a tax strategy that is going to help me keep more of what I earn? How can I maximize my Social Security income? If you are like most people, you are getting closer and closer to your retirement and may be wondering if you're taking the right steps. If you're in retirement, you may be wondering, am I maximizing my income while preserving my estate and caring for my family? We talk about all things financial in what we call three-dimensional investing, putting a plan around your financial future. If you feel that now is the time to start getting the answers to some of these questions for your own situation, give us a call at Brayshaw Financial Group at 855-226-8551. Headquartered in Bedford, New Hampshire, we have offices throughout New England and across the country. We would love the opportunity to show you how we can help. There's absolutely no cost or obligation just to meet with us, and we welcome you to our office. Call us at 855-226-8551.
Now back to Money on Tap with Ben Brayshaw, John Ryder, and Seth Krussman.
Welcome back. You're listening to Money on Tap. Now, we've got a little bit of time left here talking about active strategies, passive strategies. We're going to talk about some of the active strategies that we deploy with our clients. And we've been pretty excited about what's been happening lately in the market and how those guys have been taking care of business.
Yeah, I mean, we are heavily into the tactical world. We have tens of millions of dollars in tactical investing alone, separate from passive, all the other investment work that we do. And, one thing that, 2018 had, because we were just talking about 2008, but 2018 had was volatility, right? It was
a lot of it.
A crazy scenario because we had a huge tech bubble. And people didn't even realize it.
Again.
Well, yeah. The FANG stocks, the Facebook, Apple, Amazon, Netflix, Google, huge performers. And that brought the S&P index up pretty nicely for people in their portfolios. But when those companies tanked, it brought them down very, very substantially.
Yeah.
Problem is most of the rest of the market was pretty much insignificant in the performance piece of those index spaces. So one of the things about the tactical work we did, and what was really interesting was that over 90% of the assets that we had went to cash in the month of November. So the tactical triggers, the technical analysis behind moving day averages and the triggers and the kind of like the foreshadowing of bad things coming in the marketplace started going off for all the managers we work with. Okay. And by November, over 90% of the assets were in cash or cash equivalents. That's like treasuries and T-bills
Absolutely.
and money market.
And that's not to say, guys, that we didn't see some market correction, and we certainly did see the assets go down in value.
November went down
but
a little
before
bit.
they really plummeted, before they went south big time, that move to cash really helped quite a bit.
Yeah, and I think, that was great for people. In transparency, though, during the year, we're not heavily invested in those tech spaces. I mean, if you were solely invested in that tech space, you would have seen a huge rise and then a huge fall. So we were so much more melancholy for the year and the capacity of growth and performance and stuff like that. But, it's sometimes, and we say this to people all, pretty regularly, like it's not how much you make as much as it's how much you lose. You got to make money. But when you protect from the downside, now when you go back in you're potentially at a much lower opportunity to see growth because it's the volatility you need to protect yourself from. So, going to cash and, kind of, or cash equivalents and kind of understanding what does that mean? Like, how does that affect my portfolio? Did you like liquidate the portfolio? Yeah, we sold assets, but it still sits in the account. So different holdings that might exist, stocks, bonds, ETFs, mutual, whatever might exist in that account, just went to cash. A small portion, a little less than 10%, went to short-term bonds. As one of the tactical managers we use chose bonds as a portion percentage. But you'll see a lot of different treasuries and T-bill assets inside their ETF kind of scenarios that own those. I mean, there was Vanguard in there. There's all sorts of different little companies in there that you can utilize for that. And if you're looking to do some of this tactical investing, this is not something you do on your own. Like this is a, do not try this at home.
Scenario
warning should be plastered all over this. But, I think 2018, was significantly different, right? In our newsletter, we remarked on, how the Dow dropped 8.66%. The S&P was down 9.18% just in December. And the NASDAQ was down 9.48%. I mean, people are hoping to make, 10% in a year or not lose 10% in a year. I mean, these are common things. But for those types of swings to happen in a 1-month cycle, that's unprecedented volatility. This is not small. This is enormous. I mean, when you could start saying that this December, you have to go all the way back to the Depression to mark a December as bad. I mean, that's a complication that people can't understand. They can't understand that volatility, but that's literally a nuclear bomb almost going off in our market. That's scary. I think as we work with people, we don't believe tactical investing is the only way to invest. We don't believe any one way is the only way to invest, but we also believe that there is value to all of these. And we have clients who are just in active managers, and we use them all the time. We have passive investors, and we use those passive investments all the time. And we have people who really like the tactical. And I find the tactical seems to be something that a lot of people who are in retirement really appreciate. They appreciate the fact that they say, I want market exposure, but I want to know when the really bad times happen that someone's looking to reduce that substantial loss that I could potentially see. Because I don't want a 2018 or a 2008 to happen in my portfolio.
Especially as I get closer to that retirement date.
I can't afford a 15 or 20% loss.
Right.
If you're sitting there, I mean, and this is something this is new to you. This is something that you're saying, maybe I need to have a conversation with somebody about. Give us a call because this is a huge topic. And like we said, Wikipedia can't cover everything in this as we went through, but there's a lot we can.
If you're looking at your quarterly statement, your year-end statement, you're just like, wow, I don't even know where to go from here. Give us a call. We'd love to talk to you about that and see how we can help you.
We've talked a lot about investing today, and we've covered some of the factors that we look at when making recommendations to people regarding their investments. We've also spent the majority of our time talking about passive investing and active investing. And when I think about active investing, I think about my grandfather who worked for John Deere, and he would follow John Deere stock. And it was like clockwork for him. He would buy it when the season was off and it was low, and he would sell it when the season was up and it was high. I mean, that was a form of active investment. And that was my first introduction to what active investing was, as a matter of fact. And then I think of the passive investors who, if you look at some of the reports from, I think it's Fidelity, some of their clients that they were trying to monitor how they were doing had forgotten that they even had an account with them. I mean, that's passive investing if you want to take a look at passive investing, right? You don't even know you have the money in the market. So, between the two, we'd like to take a look at both sides of those. And really, it's about how do we help you today? Where are you at? And what kind of investing makes the most sense for you? You might gravitate towards one type or another, but it ultimately boils down to how do we help you take that next step on your journey and make sure that that's one that's successful. One thing to remember might be that as you choose to have your investments invested passively and the other portion of your investments to be more active, that you might get a checkup. And that's a phone call, folks. That's you picking up the phone, giving us a call to have a checkup. Let's take a look at that plan together and make sure that what you're doing, you understand exactly how that's going to work out for you in the long term. It's been a lot of fun. You can reach us at 855-226-8551. Thanks a lot, you guys. Good time.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.